Global credit card usage by country to 0 to 5. A deep dive. In today's interconnected financial world, credit card usage has become an important indicator of a country's economic development, financial literacy, and consumer confidence. As we step into 2025, the landscape of credit card adoption shows a fascinating mix of mature markets with near-saturation levels of usage and emerging economies where growth potential remains enormous. Top countries by credit card usage percent of population 15 plus. Canada to 82.7%. Canada continues to lead the world in credit card adoption. More than 4 out of 5 adults own at least one credit card, reflecting a highly developed banking infrastructure and widespread trust in cashless payments. Japan to 69.6%. Japan's consumers have historically preferred cash, but in recent years, government incentives and a shift toward digital payments have boosted credit card adoption significantly. Switzerland to 69.2%. Known for its robust banking system, Switzerland ranks among the highest in Europe for credit card usage, signaling a culture of financial discipline and convenience. United States to 66.7%. Although the U.S. is often seen as the home of credit cards, its penetration rate is slightly lower than Canada's. Still, Americans are among the highest spenders per cardholder globally. United Kingdom minus 62.1%. The UK has a strong credit card market with multiple rewards programs and a mature credit scoring ecosystem that encourages card usage for both spending and credit building. Italy to 57.8%. Italy is steadily moving toward a cashless society, with more people adopting cards, especially post-pandemic as online shopping continues to rise. Australia to 51.4%. Australia remains a high credit card usage country in the Asia-Pacific region, supported by a competitive banking sector and reward-driven consumers. China to 37.9%. China's relatively lower credit card penetration is offset by the massive dominance of mobile payment platforms like Alipay and WeChat Pay. The preference for e-wallets has slowed traditional credit card growth. Russia to 25.0%. Russia shows modest penetration but has seen growth in installment card products as consumers look for flexible payment options amid economic challenges. India to 4.6%. India remains one of the lowest credit card penetration markets despite rapid growth in digital payments. The huge potential for expansion is attracting major global payment networks and fintech startups. Why credit card usage matters. Credit card penetration is more than just a payment statistic. It is a mirror of a country's financial inclusion, trust in banking, and consumer confidence. High penetration rates usually indicate strong banking infrastructure, widespread credit literacy, adoption of digital finance tools, growth in e-commerce and online spending. On the other hand, lower rates often reflect a cash-dominant culture, lower banking access, or reliance on alternative digital payment methods.
Trends to watch in 2025. Shift to mobile and contactless payments. Even in high-penetration countries, contactless transactions are replacing physical card swipes. Buy now, pay later BNPL. This alternative credit model is gaining traction and could compete with traditional credit cards. Financial inclusion programs. Countries like India and China are heavily investing in fintech and government-backed initiatives to bring more citizens into the formal credit system. Security and fraud protection. As card usage rises, so do cyber threats. Expect stronger authentication methods and AI-driven fraud prevention. Conclusion: the global credit card market is far from uniform. While Canada, Japan, and Switzerland represent near saturation levels, countries like India and Russia still have tremendous room for growth. 2025 will likely bring continued digitization, innovation in credit products, and a gradual move toward a cashless global economy. For businesses, investors, and policymakers, these numbers are more than just statistics. They are a guide to understanding consumer behavior, financial stability, and opportunities for growth in the world of digital finance.